Well, hello everybody. This is Ken Winans and Rocky Balboa. As you probably noticed, Stephanie has a few bruises on her face from a home improvement project that she and her husband were working on. So there's no fights in this office. She and I are still working well together. But anyway, listen, it's been a while since we had a video, and I just thought it'd be really important for us to give you kind of the summertime thoughts as we move forward. So first off, as you all know, I'm a very big believer in seasonality of markets. I've studied it since 1970, and some studies going back even further. But the summer times can be very volatile in the financial markets for various reasons. With that being said, we're here, we're doing our jobs, we're doing research all the time. And a couple of thoughts. Number one, we are entering this post-COVID reopening the economy world. And as many of you know, we do have an office in Las Vegas. I've been spending a fair amount of time there recently. And it was interesting being in a different location to see what was going on there, and certainly same with New York. It's going to take time for things to reopen. I do not think this is going to be a unified, everything goes full bore, as of June 15th in California, or other places are doing it differently. I think, trying to reopen a $12 trillion economy, not to mention the global economy, is going to be a problem. It's going to be problematic. It's going to take time with fits and starts and all these other things. So with that being said, we're still somewhat cautious about how things are going to play out. Clearly, there's some companies that are doing better than others. There's still concerns I have about why certainly tech is not acting better, even though they reaffirmed their guidance for the year. But with that being said, we are going to be doing rotation within the portfolios. And as you know, I'm still very bullish on commodities, and we'll also be buying commodity-based companies. I do not agree with the Federal Reserve about the inflation picture. I do think inflation is here. It's very hard to get rid of it once you have that kick up, and I think that it's something we will be dealing with for at least the next couple of years at a minimum. So Stephanie, what would you like to add?
Well, first, I'm okay. I promise.
She's doing great.
I had an accident. My husband and I are doing a remodel of our house, and a door jamb fell on me, but I'm okay. But Ken's been teasing me all week, calling me Rocky, so it's all good. We're of the same minds. We are ready to do a rotation. We do like that we're getting some traction in certain sectors. We will be a little bit more aggressive in moving towards them. But as you know, we've been really cautious in our approach this year. Part of it is just the nature of math, right? If you go down 20%, from 100 to 80, it takes 25% to get back to 100. So we always want to be a little bit more cautious when it comes to losing money and sticking our neck out there. We want to be very certain with what we want to do with it. It's always easier to lose it than to make it. So anyways, that's just kind of that. From my end, I've been focusing on the bonds and the preferreds. I have been supremely frustrated with the amount of calls that we've had. I'm complaining vocally to Ken regularly. Even bonds that mature in 6 months or 9 months are getting called, and I think it's ridiculous. So we've lost at least a dozen bonds and at least a dozen preferreds. The good thing is I'm still able to get good paper. It's just taking a lot of work on my end, which is fine. That's our job. But I would like to see that slow down, but companies are refinancing. They're taking advantage of the market as it is, and I can't really blame them for that,
Well, and also remember, the government is still throwing a lot of money at companies and people. We all know about the stimulus packages that are out there, and I think it's safe to say that a lot of companies are getting free money from the government, so why not pay off your debts? I mean, I think it's simple to look at it that way. I'm troubled by, as many of you are as well, the deficits that we're running as far as what money's being printed and what it's being maybe used for. But hey, this is the world we're in right now. What is important for you to remember, we have studied the past. I'm particularly still think this reminds me eerily a lot economically of the 1970s. I'm hoping I'm wrong. I mean, many of you have said, no, Ken, I think the market's going to take off, the world's going to be great again. I hope you're right. I know what inflation looks like when you inject it into an economy, and there are big convulsions going on. I think one other thing, we've been asked a lot about Bitcoin. I thought it was a bubble for a long time. I still think that it does not act like a currency. I've studied currencies most of my career. That is not a currency. That is a commodity. When things blow up like that, those are commodities. So again, I'm not saying it doesn't say anything about being negative on Bitcoin. I'm just cautioning people when things go straight up, they usually don't keep doing that. And when you have, in the economics, we call it speculative excesses. And when you have things like that blowing up, I mean, I am somewhat concerned. I think the housing market has gotten way ahead of itself.
Yeah.
You can blame shortages of housing, but I look at a house as a combination of commodities. A house is lumber, cement, steel, copper. And I think housing prices are also going up to reflect the replacement cost of those houses if you were to rebuild them with today's commodity situation. This is the same stuff that happened in the 70s.
Yeah.
So what we all have to be cautious about, and the question that we have to ask, is what is going to happen when rates begin to go up, when the Fed turns off the stimulus packages? We don't know yet. It could be the economy is strong enough by then that it does move forward and everything's fine. I don't know how housing's going to react to mortgage rates beginning to climb back up. Again, those are things that Stephanie and I are spending a lot of time looking at closely and trying to determine what it does to the stock market.
Well, and Ken was just saying this morning how he thinks Jay Powell is wrong about inflation. You know, inflation is turning into the really big elephant in the room. Someone, I forget who it was, one of the talking heads last week was talking about it, and Jay Powell was about, oh, well, we need to ease. Janet Yellen is starting to slowly bring that into the conversation, and the market's freaked out for a day because they're just not quite ready. We don't feel the market has enough legs in it, to be honest. So we are concerned, and the housing is an interesting piece because commodities, the wood and the cost of lumber and everything has gone up so much. Actually, the construction has gone to an almost halt, and it's you can't. Business owners can't judge the cost of the end product if the inputs change so rapidly, and they have aggressively just in the last couple of months. And so what they're doing is they're pausing. They don't know what else to do at this moment. So what also happens if supply shrinks again? We don't know. So
yeah, exactly.
Yeah.
And then just a couple other quick things, and it's not meant to be any kind of politicizing this issue, but if you are looking at a Federal Reserve that is considering backing off of their accommodative strategy, and then you're looking at the possibility of taxes, investment-related taxes going up this year, folks, those are some very strong headwinds. And I would be very cautious with those variables in play. Go pull out my book Investment Atlas and go and see what happens when the capital gains rate goes at 40% or higher. The stock market goes sideways. Housing will begin to have trouble. So I'm just saying that there's a lot of variables there. I am hoping for the best. I always am. I'm an optimist at heart. But just be aware that Stephanie and I are here. The whole team here is trying to work through things. I know I'm very excited about our new platform that you're all going to like. Our new statements that are going to be coming out at the end of June. You're certainly going to like the new online platform that we're coming out with. So we're making the necessary technological upgrades to better deal with the markets going forward. But anyway, what else do we want to talk about?
Well, a couple things, yeah.
Sure.
So we are in the process of rolling out Tamarack. We've reached out to a dozen or two clients, I think kind of a beta group to make sure everything's all smooth. So far, the feedback has been extremely positive. We're very happy with it. So Amy and I and Brittany and Mindy, we are all going to make a big push to get everybody onto the platform before the end of the quarter, because that's how you're going to receive, at least partly receive, your quarterly report from us, your new report. We can traditionally mail it as well. There's actually an option you can do just the portal if you want to be a little green and save some paper. So we're doing that. We also are in the process of working with Fidelity. So we are not happy with the merger between Schwab and TD for several reasons. I almost would have preferred if TD bought Schwab, ironically, as opposed to Schwab buying TD. But we don't know what the current state's going to be. We know it's going to be an absolute mess when they really start doing it. And we want
real quick, Steph. And folks, this is not happening until next year. We just want to make sure there's nothing you have to do this year. There's no panic. We don't need any more drama. We've all had plenty of it. So
no, it's not even that. We know it's coming down the pipe. It's an inevitability. Technically, if you talk to our TD rep, they say they work for Schwab now. So it's a fact. Mm-hmm. But we want to have a dual custodialship. We want to have another option. So we're going Fidelity. We also know several clients have told us that they really like Fidelity, and if it was an option, they would like to go for them. So in also the rollout of Tamarack and getting on the phone with all the clients to really walk you through it, make sure everyone's comfortable with it, I am also going to ask if you would want to maybe move to Fidelity if that's something you would be interested in. They need an indication list from us. And so we're going to begin that process as well. We'll just do it in tandem, kill two birds with one stone.
Exactly. And by the way, there is no obligation for you
No.
to move. We're just, our job, we're a fiduciary, we work for you. And if we do not like how the custodians operate, now we all know it's been very frustrating dealing with custodians through the COVID environment. It's been tough on everybody. But the reality of it is, I have been in this business a long time. I know that when there are consolidations, especially amongst these big firms, it's rarely smooth.
Yeah.
I mean, I remember when Smith Barney merged in 2008 and 9. We had money with them, and it did not go well. So I'm just trying to say, you have a choice with us, and we will talk to you about that as time goes on. Only other thing I'm going to bring up to you, we are going to be starting to do more now that things are opening up again. Our offices are open. You're always welcome to come by here with mask or without mask. I guess after June 15th, we don't have to wear the mask anymore. But we are going to do more webinars. We're actually going to have a webinar series coming up here pretty soon. The title of it is Thinking About Moving. The Las Vegas Chamber of Commerce has approached us about the possibility of coming out here and talking to folks in California who might in fact be interested in considering relocating to Nevada or another state. So anyway, don't get us in trouble with the state of California. But since we have offices in both locations, we thought it would be informative for people to at least hear what their choices are. It will be recorded. It will also be in person. So we're going to be doing more things like this as we go through the rest of this year, going into next year. I guess the only other thing I would bring up is, as Stephanie pointed to, we're spending a lot of thinking time right now, thinking through this economy in these historic times. As a historian, part of me has to almost pinch myself to say, wow, we are in one of those really interesting times. But from a practical side, we have to look ahead and try to figure out the best course of action for us to maximize intermediate and long-term returns. So although we might be holding, maybe we raised too much cash too early, the year is not over yet, and I still am very comfortable with the status we're taking on how we're going to move forward going on that. And then one other quick thing I would bring up. There's a lot of, as I just did a full round of research earlier this week, and it's very clear there were companies that absolutely got mauled in earnings season. They missed it, whether it was, and a lot of it was because of commodity cost. They missed their numbers because of increased cost, whether it's fuel, whether it's raw materials. And I just have a strange feeling we're going to be hearing this more and more coming from a lot of the companies that we have stock ownership in, that their labor costs are going up, their material costs are going up, their cost of doing business is going up, and that eats into their margins. And as I said, the market right now seems to be priced for perfection. And I just see a lot of things there that are not perfect and could really throw a monkey wrench into things. We're not talking about a full-blown doom and gloom bear market, but I think a 5 to 7%, possibly 10% correction from today's levels is just not out of the question going through the summer. So that's again why we're still holding cash.
Yeah, we're conservative, that's all.
Yeah, that's it. Well, that's it, folks. We'll talk to you again in the next couple of weeks, and please feel free to call us if you have any questions, and we hope you're staying healthy, and hopefully you're going to get out this summer and try to enjoy some nice activities. But anyway, if those of you who are not in the Bay Area, if you happen to be in the area, please come by and see us.
Yeah.
Take care now.
Speak to you soon.
Bye-bye.
Bye.